Good morning, everyone. It's Ben Buckner with Dan Bossy from Ag Resource. Coming back to you. It's Thursday, October 23rd. We've got markets that are firm, steady to higher. Soybean still adding some premium on complete unknowns of what happens this week, next week between U.S. and Chinese trade talks, next week specifically. And if China does come back for some kind of token tonnage of U.S. bean purchases December and January. So everyone's balance sheet probably looks very, very different. And it's still clear to me that the market's not really inherently pricing anything in. It's just the latest social media post. Do we get a deal? Do we not get a deal? We are on to South American weather, personally at Ag Resource Company. But Dan, what else are you seeing in the markets today? There's a lot of little things happening.
Well, there are, Ben. I mean, when you look around the world, there's a lot of tensions right now. And whether it's the gold market, which seems to be moving in $102 clips, we've got crude oil up, nearly $3 here this morning. So there's a lot happening. A lot of it all promoted by our president, including the cattle market, which has really riled a lot of cattlemen in terms of his importation of beef and his programs. I expect, like everything that happens in this White House, there'll be a lot of court challenges and delays. We're seeing that already in things like RVO and SREs. And we do have FSA offices open today, to throw out another acronym. But that in mind, we're also getting close. If we don't get the U.S. government back open, I'm fearful that the November crop report may become the January crop report if we don't have something opening next week. NASS needs to do their analysis. That would happen next week, and getting the government open probably by Monday or Tuesday is key to getting that November crop report. But let's kind of hop into where we are here today and what's going on. The one thing I would tell everybody, that if we take a long-term global perspective, notice how in the square boxes over the last year or so, that the wheat market, the corn market, the soybean market has all been kind of caught in a range. And a lot of times it's been not an easy range. It's been difficult to trade depending upon the geopolitics at the moment. But notice that we really haven't gone anywhere. And it's a flip back and forth depending upon the hemispheric seller. Case of beans, Brazil gets cheaper, or Argentina versus the United States in the winter, and then it flips back the other way in the in the harvest time here in the United States. The wheat market is very consolidated. Everybody's kind of at the same price, looking for new demand. Russian wheat prices are a little weaker here this morning, 230, 231 a ton. There's still all this talk about China maybe looking for wheat in the world market, either in Argentina or maybe Europe, Baltics, or France, but we'll see how that pans out. And then in the corn market, as you look at this, we had a big rally in Ukrainian corn, but the United States, because of its big crop and the sizable crop, a record crop in Brazil and South America, really kept things under wraps. And so, Ben, I want to at least put that in that framework so people get a sense of where the global markets have been. Now, we do have this U.S.-China negotiation. President Trump is talking about normalized Chinese buying of soybeans. I'm not quite sure as an analyst what normalized means, but if the Chinese were to start buying U.S. soybeans normally going forward, we estimate that it may be something like 5 to 8 million tons to fill in a void between, let's call it the middle of December into the end or middle of February. That's our window of opportunity. Now, again, I don't think the U.S. is going to get business beyond that. The Brazilians are cheaper than the United States Gulf from the period of really the end of January through the end of May. So we really don't have an export opportunity. The next one thereafter would be June, July, and August, the last quarter of the crop year. We'll see if that pans out. But again, I don't think the market, if you look at where soybeans are relative to last year, now being up about 50 cents a bushel, let's say we did get a deal for 5 or 7 or 8 million metric tons, and I don't think it'll be tonnage specific. I think it'll be broad brush and saying, okay, normalize trade again. The market would like that for a while, like maybe a few hours, but I'm sure, to your point on South American weather, with a large crop in Brazil in the making, I don't think anybody's going to buy into the U.S. market longer than that. So that's the next sell opportunity as we think about it going forward. Chinese crush margins are negative, though the Chinese have been, of course, crushing rather actively. We had another strong crush this week. So again, I think you're to the point where you're going to start to see Chinese crush margins come down. And so as you look at soybean stocks and port stocks of soy products and soybeans, we're at levels that are quite high. So the Chinese have stuffed full their markets in anticipation of this trade debate that will be happening later this week and on the weekend. Now, in terms of Dalian soybean meal prices, it was up. So I'm surprised. I thought if we were going to do a trade deal with China, the Dalian meal market would come unglued to the downside. That hasn't happened. So it looks to me like our Chinese friends are not expecting a deal. So that's where the tensions really rise in terms of what to expect of the Chinese in these negotiations this weekend. We'll see what happens, but it is not clear to us that the Chinese are ready to do a deal, even though the threats from the Trump administration are quite high. When you think about Brazilian soybean sales and exports to date, notice how in the case of vessel lineups and shipments, we're well above the pace of the last couple of years. That's the chart on the right. And in terms of Brazilian sales or export commitments, we're now at levels that are above the USDA. So it tells me that the Brazilian crop last year is understated. We believe by 2 or 3 million metric tons, maybe 171 to 172, which is what our crops were last January kind of indicated anyway. So as you think about Brazilian supplies, we'll watch sales and exports now very carefully because it will delineate what supplies are left in the Brazilian market. Brazil always sells to near zero in the crop year. Their harvest starts here. So we should have a good sense of what last year's crop was relative to exports and commitments in weeks to come. And we'll keep you all up to date relative to that. As you also look forward, you can see here that on red, this is Brazil exporting soybeans to China. We are in blue. Green is Argentina. Notice that the last time China took soybeans from the United States was a very modest amount in July that shipped out in June, late May, early June. Since then, the Chinese have imported any U.S. soybeans. So even if we restart the sales of U.S. soybeans, likely in 6 weeks is when the next vessel could load, the middle of December. That means that those soybeans would arrive sometime in the, late January, February timeframe. So the point in this graphic is notice how much red there is looking backwards in time. The United States is becoming more of a residual supplier of China. So even if we do a deal with China, I'm not expecting us to get back to the heydays of doing 24, 25 million tons to China. I think that number is going to be closer to something like, 11 to 15. And unfortunately, that means we need to look to other places in the world to pick up that demand. A lot of talk in the farm circles about the monopolies of seed and chemicals and of course, equipment. Though, as you look at this graph here, I want you to focus on the black line. That is the, of course, percentage that fertilizer and fuel play into average cost estimates. We've updated it for 2026 there. Notice that fertilizer prices are up, but the big gains are going to be in things like equipment, land, and rent. So if you really want to talk about getting a structural, American farmer getting structurally right, we need to see land rents or land costs come down. Unfortunately, that's not always the best thing for American agriculture. And the other thing is equipment costs are still very, very high, much higher than would be expected. So with that in mind, I think farmers will utilize its equipment longer, not changing every tractor or combine back every 1 or 2 years on a lease agreement. I look for the extension, if you will, on equipment being longer than that in terms of ownership. And so the key numbers that need to come down if we want to rebalance agriculture to the new market norm of grain prices, it likely has to come in the land and equipment, though fertilizer can help. It's not the panacea everybody would like to make it. Lastly, we'll end up in talk here just a little bit about where land rents, and this is a map that came out from USDA a few weeks ago. You can see land rents are coming down or softening in some areas of the eastern Midwest. That those areas are the ones that I believe should be the places showing those land rents in decline. Then in the other chart, you can see we plotted corn revenue in Illinois against Illinois farmland prices. So again, there's a rather strong correlation between revenue per acre on corn and what farmland prices normally do. That has broken down in the last 2 or 3 years, something we need to pay attention to. We're not including in this graphic farm payments from the government. So that may be one thing you need to consider. But as you look at this graphic, it's not going to be because of the price of corn or because of the yield we get per acre. Farmland prices may hold because of government assistance, including PLC and some of the others programs that are out there. So as we think about the market longer term, I know we're looking at a China trade deal potentially this weekend, and let's hope the U.S. government can get one. But I believe longer term, it's all about weather. And Ben and I have been very consistent in saying that at least for now, South American weather looks nearly ideal. the ensemble model for the European forecast model. That is your left for the next 2 weeks. Notice all of the rain from Argentina northward into the Matiba in terms of Brazil, Mato Grosso, Goiás, Mato Grosso do Sul. Everybody gets covered up with 1 to 3 inches of rain. This is a good start, and then temperatures are rather cool, though there is a chance of a frost, if you will, across portions of Argentina early next week. I think that frost would be more important to wheat than the corn crop, which is now coming out. But all that said, Ben, if we have big South American crops, all of this trade talk with China won't matter very much. I think farmers need to reward rallies as we look forward. Back to you, Ben.
Yeah, thinking about also the USDA's trade matrix globally as it stands today is assuming a sub-trend Argentine corn yield. So that's something that we've been kind of focused on. What does the reality look like 3 months from now? But yeah, so it's we're trying this week, and really since the government's closure, trying to put things into context, big picture, long term, and of course, $1 gets you in 30 days. We're looking at supply and demand to U.S. and globally probabilities, not this year, but also next year. And so it still comes down to, I think, to change these numbers and balance sheets, you got to have a weather threat. So keep that in mind. Also, we're not terribly far from some soybean targets that we have. So check those out for new cash sales. All the best in the markets. We'll be back later, and we'll see you then.